Hi everyone, this is Anna from hotoptionbabe.com. Up here I wanted to show you this income earning strategy with options that I've been doing, and it's really nice because you don't have to micromanage it. And in this sort of sideways wave 4 that we're in right now, this is a great strategy for income. And what it is, it's a credit spread. And so instead of a debit spread where you buy a call or put and then you sell one further out for income, you're doing the opposite. You're selling one. Ow, the cat just stopped on my foot. You're selling an option that you believe the stock will pin at the expiration, and you're buying a call or put for protection. And now in this case, I've been doing Priceline a lot because since it's earnings of I think it was the first part of November, I've done it 3 times for an average of around $370 so dollars, 350, 380, so say 365. And the first 2 times I kept all the credit, so I made 100% on it. This last time I sold it for $370 and bought it back for 95 cents. Now, can you imagine you sold your car for $5,000 and you bought it back for $95? That would be a great deal, wouldn't it? I mean, think of that's nice profit. So that's how you have to look at credit spreads. It's just doing the opposite of a debit spread. Now, I go with the weeklies, and the reason I go with the weeklies is because I'm working off of theta burn. I'm working off of that as each day goes by. That strike that I sold, if it remains near or at that, or it goes in my direction, I start to make money every day until Friday comes up, which is 5 days from now. So think about when you own an option 5 days out, how fast do you start seeing your money go out? You see it go out really, really fast. So this is a great strategy for people that don't want to micromanage or just want to add an additional strategy to their toolkit. Okay, so now I've been doing the range of Priceline between 410 and 430. Now it's at 410.87 where it closed on Friday, and I had sold a 420 call spread, so I actually closed it out for 95 cents because it looked to me like it was not going to pin exactly at 410 where I would have made 100%, but I did really good, so that's fine. And I plan on doing it again tomorrow. I want to wait to see where Priceline opens, but I do want to show you a risk graph on this trade, and I want to show you how you do it. So for those of you that are new to options, that you have an idea how it works. Okay, this is the bid, this is the ask. Okay, if you were buying, let's say you were really bearish on Priceline, you might buy the 410 put spread. But in this case, you're selling it. So you're going to sell the 400. Oh, sorry. Oh, that's right. Okay, you're going to sell the 410, and you're going to buy the 400 for protection because you're a little bit bullish. You think that it's going to stay at 410 or above. Okay, I'm not positive this is what I'm going to do yet because I got to see how it opens up tomorrow. More than likely, I'm just going for where I think the stock's going to end at Friday at expiration. Okay, but this is just for teaching's sake. I'm going to sell, and I'm going to use one for teaching's sake, Priceline, December 410 put. I'm going to buy one Priceline, December 400 put for protection. Because the risk on this trade, now you're going to take in $3.57 credit, and you hopefully will keep the entire amount or close to it. Okay, you're going to confirm. So this is your risk. You are going to, the max you profit you can make is $3.57. Your break even is 406.43, and I'll show you this on a graph, risk graph in a moment. And risk graphs are always good if you can get into options, learning risk graphs. I can glance at an option strategy and look at the risk graph, and I know whether it's worth the risk. The maximum loss will be $643. Well, why $643? It's the difference in strikes minus the credit you took in. That's your risk. yeah, you say, well, there's more risk than there is reward. But you have to look at it like this on a credit spread. The probability is higher that you are right because you do not have to just go in one direction as you would on a straight call or put or a debit spread. Because you know on those, if your stock's not in the money on your strike you bought, you get that theta burn and you lose money. You're like, God, I lost money, and I don't understand it. And the reason why is because the theta will get you unless you're deep in the money towards expiration. So I'm working off of somebody else's pain. I hate to say it, but that's basically what it is. Okay, so we're gonna I already queued it, so we're gonna edit it because I'm gonna show you. I'm gonna go in here, analyze. Okay, and here's your risk graph. Here is your credit spread. This is your risk. This is your reward. Now, if this stock stays at 410 and above, you're going to make 100% of your money. Now, to break even, your break even was 406. Where's that little line at? I think it was 40. Was that it? 406. There it is, 406. Right there's your break even. Okay, and this is what the risk graph looks like. It actually looks like a if you flip-flop this risk graph to the other side and had it going up here and here, you would have a debit spread. So you're selling to somebody that debit spread that you sometimes buy when you're doing options. I hope you guys really understood this because it's such a great income earner. I mean, I did really well. Each one has worked out really well. I'm pretty good at picking the pins, so if you're not comfortable, join me in the lounge. You get a free week, But that's what I am known for, is market direction and options. So it's a great income earner, $1,000 a week. Doesn't that sound good? It's been good to me, and I'm really happy. I'm actually redoing my kitchen. So you guys have a great rest of your holiday weekend, and I will see you soon.